Hey guys, welcome back to this new video. So in this video, we'll be discussing about the accounting terms in detail. So let's start with the video. So the first accounting term is business transaction. Now, what do you mean by a business transaction? Business transaction means an event entered by two parties and is recorded in the books of accounts. So it is an agreement between two parties involving the exchange of goods and services. For example, when you buy a pen, so two parties in this example would be first would be you as the customer and second would be the shopkeeper. Okay, so the agreement here is of buying and selling. So it is concerned with money or money's worth of goods and services. It has two aspect or a dual aspect. Why a dual aspect? Because one side would be the receiving side, that would be debited, and the other side would be the giving side, that means it would be credited. Like you're getting pen and to the shopkeeper you're paying cash. So what is coming in? Your pen as an item is coming in and cash is moving out from your pocket. So what do you mean by an account? Account is a summarized record of transactions relating to a particular head at one place. For example, purchase of goods, whether cash or credit, are all shown under your purchase account. Same way, if it's sale of goods or services, either cash or credit, it would be shown under your sales account. Okay, so now is capital. What do you mean by capital? It is actually the amount that the proprietor brings into the business or the amount invested by the proprietor or the owner. Proprietor is who? He is the owner of the company. So it may be in the form of money. The proprietor may either bring in money in the business or he or she may bring in assets of a monetary value. So this capital, it is also known as your owner's capital. Okay, so it can be also known as net worth. Capital represents your net worth of your business entity. How is capital calculated? Capital is assets minus liability. If you remember the accounting equation that we done. So just for your reference, I'll leave the link for the accounting equation video in the description box so that you can check out. Okay, so now next is drawings. What do you mean by drawings? Drawings, it is the amount that the proprietor or the partner or the owner of the business, he withdraws money from the business for his personal use. If he is withdrawing money from the business for personal use, that particular terminology is called as drawings. So drawings, what it does is it reduces your capital. So at the time when you're preparing your balance sheet, drawing amount is deducted from the capital amount of the proprietor or the owner. So now liabilities. Liabilities means amount owed or payable by the business. Liability towards the owner of the business is termed as your internal liability. On the other hand, liability towards the outsiders would be termed as the external liability. So external liability arises because of loans. If your company has taken any loans, then the company has an external liability. So examples of external liabilities could be your creditors, your bank overdraft, long-term borrowings, and other liabilities are further, if you further classify liabilities could be further classified into two more categories. One could be non-current liability, the other is current liability. So what do you mean by non-current liability? So non-current liability is that liability which is payable for a period of more than a year. Okay, examples would be your long-term loans. That means in that particular accounting year, it cannot be paid. It is paid in more than one accounting year. Now next is your current liability. Current liability means that liability which is payable within 12 months or within the accounting period. Examples could be your bills payable, your short-term loans, your creditors, etc. Okay. So now assets. What do you mean by assets? These are your properties that a business owns. So these properties could be your intangible asset and your tangible assets. Assets, they play an important role in a business. Why? Because they act as an economic resource for the business. So anything which will enable the firm to get cash or an economic benefit in future is an asset. Examples could be your land, building, machinery, furniture, stock, debtors, and so on. So assets, these are classified into three categories. One is your non-current asset, second is your current asset, third is your fictitious assets. Now non-current assets, these are those assets which are held by the business not with the purpose to resale, but they are either held as an investment or in order to facilitate future operations for the business. They are held for a longer period of time. Examples for non-current assets could be your fixed assets, your long-term loans, advances and investments. Now, what are fixed assets? Fixed assets, the examples of fixed assets could be land and building, furniture, machinery, plant, etc. So fixed assets are also further divided into two categories. That means your tangible assets and intangible assets. Tangible assets, these are those assets which have a physical existence. That means they can be seen or touched, like your machinery, your furniture, your land and building. Intangible assets are those assets which do not have physical existence. That means they cannot be seen, neither touched. Examples could be your computer software. You cannot touch your computer software. The goodwill for the firm, your patent, your trademarks. These are examples for your intangible assets. Now, what do you mean by current assets? Current assets are those assets which are held by the business with the purpose of converting them into cash. They are generally held for a short period of time. Non-current assets were held for a longer period of time, whereas current assets are held for a shorter period of time. That means for less than a year. Then comes your fictitious assets. These fictitious assets, they are neither your tangible assets nor your intangible assets. These are actually your losses that are not written off in the year in which they are incurred. That means for the accounting year, if you have incurred any loss, in that particular year, that loss has not been written off. That means zero. If that particular loss is not been written off to zero, these losses are further transferred to the next accounting year. So these losses are your fictitious assets. So they take more than one accounting year to be written off. So clear with non-current assets, current assets and your fictitious assets? Now let's move on to the next page. So now expenditure. Expenditure is the amount spent or a liability that is incurred for acquiring a asset. So expenditures is further categorized into three categories. First is your capital expenditure, second is your revenue expenditure, and third is your deferred revenue expenditure. Now, what do you mean by capital expenditure? So, it is an expenditure incurred to acquire asset or improving the existing assets which will increase the earning capacity of the business. This means either an expenditure made on purchasing the asset or upgrading the existing assets. Any expenditure relating to these items is termed as your capital expenditure. So it may be incurred to acquire either your tangible asset or your intangible assets. Examples could be your purchase of furniture, your purchase of computers to carry on business. So these are all your capital expenditure. Capital expenditure is shown on the asset side of the balance sheet. Okay, so now revenue expenditure. Revenue, as the word means revenue means profit. So revenue expenditure is the expenditure incurred, the benefit of which is consumed or used within the accounting period. That means within 12 months. Okay, so it has a direct relationship with revenue. Examples could be your cost of goods sold, salaries, rent, electricity expenses. These are all related to your revenue, because when you're paying these expenses, your profit is reducing. Okay, so revenue expenditure is shown on the debit side of the trading account, trading or profit. Revenue actually is shown on the profit and loss account, but when you say it, it is said as trading account or profit and loss account. Okay, because it is an expense, and expense are shown in the profit and loss in case of the companies. Okay, now third is your deferred revenue expenditure. Deferred means expenditure which is not written off in any expenditure which is not written off in one accounting year. Deferred, it is getting delayed. Okay, so it is a revenue expenditure in nature but is written off in more than one accounting period. That means in more than 12 months or a year. Like for example, if you have a large advertisement expenditure, so advertisement expenditure that will benefit for more than one accounting period. Okay, it will benefit you in the current accounting period and also in the coming accounting periods. So the amount is huge. So that is written off in more than one accounting period. It could be written off in 2 accounting period or 3, but it takes more than one accounting period. Okay, so this is your deferred revenue expenditure. So now income. What do you mean by income? It is actually the profit that is earned during an accounting year. So the difference between the revenue and the expenditure of a firm is the firm's income or firm's profit. To understand this better, let's take an example. Like for example, you have goods costing 15,000 that are sold for rupees 21,000. So the cost of goods here is 15,000, which is your expense. The sale of goods, that is 21,000, is your revenue. So you will take out the difference between the two, your revenue and your cost. The difference would be 6,000. So this 6,000 is your income or your profit. So the formula for income is your revenue less your expenses. Okay, so now what do you mean by expense? Expense is basically the cost that you incur for generating your revenues or profit. So this expense, this is debited to your profit and loss account. So expenses are also further classified into prepaid expenses and outstanding expenses. Prepaid expense is an expense that is paid in advance by a firm, and the benefit for which is actually followed in the coming years. To understand this better, let's take an example. Suppose you have an insurance premium of rupees 10,000 that has been paid for 1 year beginning 1st October 2016. So now your financial year is what? 31st March 2017. This means premium for 6 months, that is from 1st April 2017 to 30th September 2017, amounting rupees 5,000 is well paid in advance. Okay, so prepaid means you're paying an expense in advance and the benefit you're getting in the following year. So thus the amount of premium paid in advance is 5,000, which is your prepaid expense. So this expense will be accounted in the financial year for your 31st March 2018. Okay, so now what do you mean by outstanding expense? Outstanding expense is that expense that has been incurred but not been paid. That means you incur that expense, but the payment for which you'll be making in the next year, or later. Prepaid, the difference between prepaid and outstanding is, in prepaid, the payment is made in advance and the expense occurs later, or the benefit you get is in the later years. Whereas if it is in the case of outstanding expense, you incur the expense first and you pay for that later. Okay, so the difference between outstanding and prepaid is prepaid is paid well in advance, and outstanding is you incur the expense and then you pay the money. Okay, so now what do you mean by profit? Profit means income that a firm earns from its operations or the operating activities that it carries on. From that, whatever revenue or income that it generates is your profit. So profit is of two types. Normally a firm earns profit like gross profit and net profit. Gross is the difference between your revenue and expenses. And net profit is the profit after the deduction of all your expenses, whatever amount is left to be distributed among the owners of the company, that is your net profit. Gross is your total profit. From your total profit, you subtract or you reduce all your expenses, your office expenses like salaries, rent, drawings and all. Every item, depreciation, these items are reduced, and after which the final figure that comes is your net profit, which is your final profit that the owners or the proprietors of your company will be getting. So this is your net difference between your gross profit and net profit. Gross profit, it includes everything. Profit before your expenses is your gross profit, and profit after reduction or deductions of your expenses is your net profit. The term purchases is used for either purchase of goods and services for resale or for producing the finished products which are to be sold. So this term purchase, it includes both your cash purchase and your credit purchase. Okay, so now next is purchase returned. At times there are situations when the goods are defective. The goods that we have purchased, they are defective. So we need to return it to the supplier. So when we are returning it to the supplier, that term is called as purchase returned or returned outwards. Okay, so now sales. The term sales, it is associated with or used for sale of goods that are dealt by the firm. It also includes both your cash sales and your credit sales. Okay, so now the next item is your sales returned. Same way, when the goods are sold and the purchaser wants to return the goods back. So when the goods sold are returned by the purchaser, that particular term is called as sales return or return inwards. Why inwards? Because it is coming back into our business. And why it is called as return outwards for purchase? Because from the firm, the goods are going back to the seller or the wholesaler from where the goods are bought in bulk. Sales return is the goods are coming back from the customer to your firm. The difference between the two is this. Now, goods. What do you mean by goods? These are the physical items that we trade in, or any business trades in these items. That terminology is called as goods. Okay. Now, debtors. Debtor is a person who owes amount to the enterprise against credit sale of goods and services. For example, when goods are sold to a person on credit, so that person is called your debtor. Because why? Because he owes the amount to the enterprise, and the amount which is due is called as your debt. Okay, so now what do you mean by a creditor? Creditor is a person to whom an enterprise owes amount against credit purchase of goods and services. For example, Mohan is a creditor of a firm when goods are purchased from him on credit. So the difference between your debtor and creditor is, creditor says is a person to whom an enterprise owes an amount, whereas debtor is a person who owes amount to the enterprise. The difference is, when the enterprise owes an amount, it is the creditor, and the debtor is the debtor when the person or a debtor, when he owes an amount against the enterprise, it is called as your debtor. That person is called as your debtor, and the amount due is called as your debt. Now, bills receivable. Bills receivable and bills payable, these are your bills of exchange. Bills receivable is accepted by a debtor, and bills payable is accepted by a creditor. Okay, for the amount that needs to be paid to be paid during a specified date. Okay, so now is discount. Discount is what? It is actually a rebate on the prices of goods or services, or it can be the amount paid by the customer. Then it is known as your discount. So discount is also of two types. One is your trade discount and the other one is your cash discount. Trade discount, it is allowed by seller on the basis of the sales. So trade discount is allowed by the seller on the basis of the sales. Whereas cash discount, it is a rebate that is allowed for timely payments of due amount. If somebody who's paying timely, that particular person is eligible for your cash discount. So cash discount is recorded in the books of both the parties. That means your seller and purchaser. Whereas trade discount, it is recorded under one party, that is the purchaser. Okay, so the difference between trade discount, cash discount, bills receivable, bills payable, creditor and debtor is clear. So now stock. Stock is your tangible asset. What do you mean by tangible asset? It has a physical existence, it could be touched, it could be seen. So that is your tangible asset. Now stock, it is held, it is an asset that is held by an enterprise for the purpose of sale. And stock is of two types. One is the opening stock and the other one is your closing stock. Now, what do you mean by opening stock? Opening stock is your stock. The stock is stock in hand. That means that stock that you hold at present is the stock in hand in the beginning of the accounting year. Whereas closing stock is the stock in hand at the end of the current accounting year. If you remember the trading account format, we start with the debit side with a debit balance, to opening stock, and end by a credit balance as by closing stock. So these both stocks, opening stock and closing stock, these both items are shown in the trading account. I'll leave the link for the trading account format in the description box so that you can go ahead and check those things. So now let's move on. Kinds of stock. So there are three kinds of stock. One is your stock or inventory of goods. So inventory of goods means it consists of, like if you take for example a trading firm. For a trading firm, stock means goods that are remaining unsold. Okay, whereas for a manufacturing concern, it comprises of processed goods. For a trading concern, stock would be different. For a manufacturing concern, stock would be different. Now, second is stock of raw material. Raw material, what do you mean by raw material? Raw material is used for manufacturing of goods lying unused. For example, stock of cloth to be used for stitching shirts. So, stock of cloth. This cloth is your raw material for your shirts. Okay. Third is your work in progress. Work in progress means that it is the stock that is in process of being finished. They are part or they could be your partly finished goods. Okay. Hope you got the kinds of stock. So now debit and credit. So as we know, an account has two parts. One is your debit and the other one is your credit. So the left side is the debit side and the right side is the credit side. So if an account is to be debited, then the entry is posted to the debit side of that account. Same way, if the account has to be credited, the entry is posted to the credit side of the account. Okay, so debit and credit. Now third is your depreciation. Depreciation is on your fixed asset. It means the fall in the value of an asset. Why there is a fall in the value of an asset? Either that asset has become old or some accident has occurred in the firm which has caused damage to that particular asset. If a damage has been caused to this asset, it automatically reduces the value of that asset. Okay, so depreciation is on your fixed assets. Now, bad debts. Bad debts means it is the amount owed to the business that is written off because it has become irrecoverable. That means we are not going to receive this amount in the future. That particular terminology is called as your bad debts. It is your loss because you are not going to receive that amount back. So that amount is your loss for the business. So all the losses are debited to your profit and loss. So this amount would be then your bad debts are shown on the debit side of your profit and loss account. Now it's insolvent. Insolvent or insolvency is a situation wherein a person or an enterprise, they are in a position wherein they cannot pay off their debts. So that particular person is called as insolvent. When he cannot pay off his debts, that particular person is called as insolvent person. Now your balance sheet. Balance sheet is what? Balance sheet depicts the financial position of an enterprise at a given date. So guys, these are the few important terminologies that we'll be using in the accountancy. Okay, so we've discussed all the terminologies in detail. So guys, hope you all understood these accounting terms. If you like the contents of our video, please hit the like button, subscribe to our channel if you haven't subscribed it yet, and become a part of our KaKsha family. And press the bell icon so that you can get the latest updates relating to our videos. Stay safe and stay healthy guys. Bye-bye.